You're going to continue to see more frustration from the masses because of the cost of living is going to go. And what other options are there? Look, the libertarian solution, my good friend and 20-year partner, Doug Casey, that solution's not going to work. You can't just let them vend for themselves because you'll have riots. So MMT is going to be a solution.
Our next guest is Marin Katusa, founder of Katusa Research and the author of The Rise of America, Remaking the World Order. We'll be talking about the themes of his book, his outlook on the economy, as well as some of the sectors that he likes and perhaps dislikes. Marin, welcome to the show. Pleasure to host you today.
It's my pleasure.
Your opening introduction really hooked me. You said that the sentiment is from the mainstream media and blogs sort of the same everywhere, at least from what you've examined. The sun is setting on the great American experiment. The U.S. economy is in a state of terminal decline. The dollar will soon become as disposable as toilet paper. Yeah, I've heard these themes before, and then you say, wait a minute, not so fast. The reality is quite the opposite. A lot's to unpack there. Generally speaking, why do you disagree with the notion that America is losing its luster?
Look, it's easy to go on social media. I just got back from Portland and not fall into the trap of, yikes, there's a lot of issues with America. And there's no doubt there is. But when you travel to over 100 countries, and it's the easiest narrative in the world to say that the US dollar is going to zero, it's not. You look at what's going on globally speaking. Look what's going on right now. There's this mantra that the U.S. and Saudi Arabia are no longer allies. You got to look not just on the political aspects, but what about from the technological? Look what Google's doing there. Look what the corporations and technologies, just like the oil companies were working very closely in the kingdom many, many decades ago. Now look what the technology companies are doing. So it's not just saying that it's not going to be a difficult game, but you look at the revolution that happened with fracking in America. That was an American technology that was felt around the world. That's happening across the board, not just in uranium and lithium. And look what's going on in the energy transition. It's going to happen. And you look at what's happening with the yen, with the euro. I just traveled throughout Europe. You look at the unemployment rates of what's going on globally and the demographics. We break down all these aspects in the book. And look, I wrote it in 2020. It was a #1 bestseller, both fiction and nonfiction, in 2021. And it is playing out. And also something I want to explain to people is even though, gold is a great place to be. And I own a lot of gold and invested in a lot of gold companies, producers. That doesn't mean that there's not going to be further deflationary pressures on some of these commodities. Because look at iron ore and copper. I was one of the founders of Canada's 3rd largest producing copper companies. That doesn't mean that there's not going to be further pressure on the commodity. And you got to deal with the realities of the inflationary pressures of the real world salaries, the COLA aspects. And many of these mining companies are going to be in a stagflationary environment, meaning their costs are going up, but their revenues are going down because the commodity prices are going down, because it is a reflection of what's going on in China. And you look at from a resource stand base that America is just getting into, you look at the incredible resource endowment that many of these areas in America that are just starting to see new technology applied to them. The highest grade operating gold mine in the world is in the U.S. You look at some of the largest producing mines in the world for the commodities are in the U.S. So the fall of America is, and I come from the mining world, so I'm going against the grain from many of my friends who are going, what are you talking about? The American dollar is done. That's actually not what's going on. So it's a counter argument specifically for gold bugs, but it is what it is.
Facts outweigh ideology in many examples, and I think this is one of them. I want to come back to the dollar because there's lots to discuss with the dollar, especially with what's happening currently around the world right now. But you did write in your book in one of the earlier chapters that modern monetary theory is one of the outcomes of the current monetary system, at least in the United States. And one of the outcomes of MMT you wrote is higher income inequality. Can you first of all explain the relationship between higher income inequality as a result of MMT and why we're going to get this?
A perfect example of what's going on right now is if you've got a lot of money, why are you going to risk it in a difficult market when you're collecting 5% in the bank? Just right off the bat there. For the people who own homes and now people who don't own homes, look at the price of housing, not just in the US, let's say North America, because where America goes, Canada is going to follow. So you have to look at it as a North American aspect. So the hurdles for people to get into the ownership is also widening. So we talk about all those aspects. You look at the payments and minimum wage going up, and you look at what's going to happen on those aspects, and it is going up. And eventually, to keep peace, you go to Seattle, go to San Francisco. They're going to have to reinvest in other forms of sectors, whether it's mental health. There's a lot of issues going on. And when you talk about just from the entrance of rent, I was reading something the other day that the average price of rent in New York is, north of $5,500 a month. So now even to get into jurisdictions where there are high employment, to get into these, even on the renting side, is going to be hurdles. So you're going to continue to see more of that. You're going to continue to see more frustration from the masses because of the cost of living is going to go. And what other options are there? Look, the libertarian solution, my good friend and 20-year partner, Doug Casey, that solution is not going to work. You can't just let them vend for themselves because you'll have riots. So MMT is going to be a solution. It's going to work itself through with periods of time. And it's kind of like, look at the transition of the education system, how it's changed. That as the demographics change and the younger generation become the middle age and then older, these new ideas will incorporate and move themselves through the system. So that's what I meant through the book, and it's playing out that way.
Well, if you're to take the position that MMT will become a more ingrained aspect of our society, wouldn't that cause more inflation, Marin? Wouldn't that cause a further escalation in the devaluation of the dollar?
So let's break down the definitions of what we're breaking down for inflation. If you look at the cost of housing, food, absolutely 100% true. But you're getting into what about the actual technology aspects when we broke down on the costs of, you look at this phone, it has more computing power than at any point, and you're getting more for less. You look at the apps, you're getting more for less. Now they're going to get you as a service. You want to keep going, pay a monthly rate and moving all those on. So it's going to become more affordable to continue, but it's generally you're getting more for less. On the aspects of MMT, we break down that what is the point of the tax aspect, and that's to create a demand on the aspect. So employment's low. And by theory, the right spot for MMT is going to be playing out not right now because you've had a COVID aspect of all this stimulus, like an incredible 6 trillion, trillions globally. Then you had the supply choke point. Now things are trying to work through its system, but you'll see an MMT will be the solution for a deflationary market. I'm not saying it's going to, like I say in the book, eventually it gets, when you're blurring the lines of monetary policy and fiscal policy, and then it becomes political policy, that's where things are going to really unwind themselves. But that's going to be what the politicians are going to choose because it's the solution at hand of the least pain. How much longer are they going to keep raising the rates for? Can the average family afford 7, 8, 9% like it was in 1980? We'll find out. I don't think so. And I think that, probably by 12 months, within 12 months, I think you'll see probably the first easing of it because the pain will start really working through the system.
There has to be some consequence to a rising debt level and rising deficit level, partly because of MMT or partly just because of decades of overspending, right? What are these consequences?
It's all relative to the GDP. That's the one thing that when you make a statement like that is, yes, you're getting higher debt, but what to the GDP and what are the interest payments? So, I find it wild that, they come out with, we're just going to delay the payment of university debt, and that these students didn't understand what the debt meant when they were 20 years old. And we can get into all that argument, but it's going to be more of extend and pretend. And on the government level, it is what it is. And you're right. At a certain point, it's going to have to come home to roost, but that doesn't mean that they can't kick it down the road further. And that's the one thing that all of these politicians will do. It's not going to be solved. That's why you want to own tangible assets. That's why the price of housing is up. That's why gold is holding in strong. Real tangible assets are the place to be. But at the same point, what I emphasize to people through the book is people are chasing these tangible assets in politically very unstable jurisdictions, and those jurisdictions are going to take that from the foreigners. So be very careful where you're trying to hold your tangible assets.
One of the themes that we examine in global geopolitics is the theme of de-dollarization. You talked about this extensively in your book. One of the facets of de-dollarization is the weaponization of the dollar. Other peers and perhaps adversaries of the U.S. are looking at what happened with Russia, for example, sanctions, and saying, we don't want to be in a position where the U.S. can just sanction us and weaponize the dollar. We're going to find an alternative to this U.S. dollar. Is there such an alternative? Does it exist currently?
When people start talking about a new BRICS currency or, a currency that the Russians are going to invent, I wish them luck in that. But, India is desperately trying to get swap lines. And we get into the swap line concept in the book. And if you look at the investments globally, unfortunately, the majority of the resource extracting industry is not in swap line nations, meaning look what just happened in the Niger and the Arlet Basin. Like, look, there's a joke in the industry, don't invest wherever there's a French embassy. And, what's Iran, the old Ariba, going to do? 70% of France's domestic baseload power comes from nuclear. Well, it means they're going to have to buy uranium either in the long-term market or the spot market, or start developing and investing in assets where the rule of law happens. So will India join? Sure, India is going to join wherever it helps their nation, but they're not going to turn their back on the US dollar. Look what Google, look at the technology companies, look at the tens of billions of dollars investment in the cloud and the infrastructure. You talk about India. I met with the three of the largest oil producers in India with the energy minister and sat down with all of their debt. It's all US dollars. They can't just reinvent it to the yuan. And if the yuan is so strong, why don't they depeg? Everyone talks about this, where they're going with the renminbi. Well, then why don't they depeg? Because they know the reality. The US dollar is strong. So as bad as everything is in America, people have to look at what is the unemployment rate in China. What's really going on with China right now? Look at their housing crisis. Why are there iron ore inputs? Look at little factors like that. Why did Saudi Arabia just cut 2 million barrels? Because China's growing so strongly that they need more oil, right? So you look at all these aspects, and I can't emphasize enough. If you think you have a good gold deposit or a copper deposit or a uranium deposit, and it is in a politically unstable jurisdiction, you may want to think about that risk, specifically in the mining sector, where discounts to the NPV are applied the same as if you're in the Athabasca Basin or if you're in Niger, which makes absolute no sense to me, or Namibia, for example, where a lot of my friends are investing a lot of money in the uranium sector. It hasn't worked out well, and I don't see it working out well. So I would be very cautious of the geopolitical risks moving forward, because rather than the BRICS coming up with a new currency or some alternative to US dollar, I think an easier step for these governments is to take these assets from these foreigners. Doesn't it make sense?
You're talking about nationalization specifically.
Totally. But not just nationalization, increasing taxes, increasing the government take. Look what Chile just did to the lithium sector, right? Those are game changers. Why did Albemarle just invest $118 million in Patriot, which is in the James Bay? Because it's a good deposit, but it's also very early stage, but it's in a politically safe jurisdiction. You're going to see more of that happen. Why is Glencore coming to North America?
Well, I'll just ask you point blank. So many people have been talking to either me or on other media about a gold-backed BRICS currency. We're speaking a week ahead of the BRICS summit. Are they going to implement this next week? What are the likelihood or the probabilities of this happening next week? No.
No, not at all.
That they're not interested in having some sort of
Of course, they
common
want to do
currency.
it. But they can't. Yeah, but then it's not going to be able to pull it off.
Well, what incentive do they have then to do what you just said, which is to make it more difficult for foreign investors to, specifically in the natural resource sector, to invest in their countries?
That's a great question, and because of the demand for these commodities, companies are already invested there. So you look what's happened to many of the copper producers in Zambia. It's there. Nationalization's been going on for a while. You look at most recently in the uranium sector. Why has there been a big push here in the near term in the Athabasca Basin for some of these companies? Breaking over $3 billion market cap, and they're 10 years away from production because people are expecting Orano, the old Areva, the French company, is going to buy out some of these big deposits in safe jurisdictions. So the world's a big place, and you're going to continue to see the big producers. Like you look at Newcrest, when now they're getting bought out by Newmont. You look at Glencore. They're all trying to de-risk their portfolio and get into the North American or Australian, what I call the positive swap line nations, where the rule of law happens.
Mm-hmm.
That's
so
the
what
trend
ultimately is the objective of the BRICS nations right now in relation to America? Now, one of the items on their agenda next week will be examining the possibility of expanding their membership to a host of other countries are applying.
Modi, the Indian prime minister, just came out and said we have no interest in moving forward. They're the eye in the BRICS. They're also the most populous nation in the world. So that just came out, and why is no one talking about that? He's openly stated that he really wants swap lines. Look, all these nations are looking for investment, and Russia's in a situation where they're not going to be investing in any of these countries. China's got their own issues moving forward, and that's going to work through itself. You look at Brazil, most of the resource industry there is backed by US dollar debt. Of course, they're going to try to create an OPEC type of thing for different commodities. But at the end of the day, where's the capital? The US dollar is the game in the global, that's the prime time show. Are they going to talk and try and have summits on that to have, some sort of a NAFTA type thing within these BRIC nations? Sure. That's not going to dethrone the US dollar.
Mm. Well, do you think that the U.S. could return, and you've talked about long-term growth in the book, do you think it could return to an era of 4 or 5%, maybe even 6% real GDP growth? Once happened, no longer is.
No, and I break down in the book like that. You look at it's a population-based aspect. We have to always look at the demographics. But in the U.S., could it get to 2.5%, 3%? For sure. And will the Inflation Act, stimulate things? Well, that's also going to create inflationary pressures in many areas, and then also create deflationary pressures in other, right? So there's a movement of it, but there's going to be no shortage of investment in the U.S. As we are in this global crux, it's about understanding the velocity of capital and where is that capital going. And to me, the opportunity as a investor, as a developer of these assets, I think the U.S. and positive swap line nations are an absolute no-brainer compared to the risks in these other nations.
Okay, well, we'll come back to that. But let's talk about natural resources. It's one of your focuses. If you were to look at where most of the lithium deposits are, for example, or copper deposits, they're not in the U.S., right? So an argument could be made that you have to invest abroad. How would you respond to that?
That's not true. So the same argument was made about oil, and then fracking came along. You mentioned lithium. Well, lithium, there's huge amounts of deposits in the U.S. on the lithium clays. So the big car manufacturers like a Tesla, GM, Ford, they want a secure, stable supply of this lithium. Whereas when you talked about Chile, which produces about a third of the world's lithium, you have to now take that process and move it to China. And now these battery companies are dependent on China. Whereas the lithium clays, you are not dependent. And in Nevada, in the US, this wasn't an option 15 years ago because lithium was so cheap that it's so abundant. It's a majorly abundant element. We talked about uranium. America was the largest producer of uranium up until 1980 and globally. It produced over 30 million pounds. It's the American technology that invented what they call ISR today. It used to, when I started on the industry, it was called ISL, in situ leaching. And you look at that technology, it was American companies that went to Kazakhstan in the early 2000s, which was only producing about 1 million pounds a year, and got to over 60 within 20 years. Talk about a 60-fold increase with technology. You talk about copper assets. I'll give you a great example. You go to Utah, there's been absolutely no modern technology brought out to areas around Bingham Canyon, which is a major, major asset that was discovered and developed 100 years ago and still producing. So you take something like in South Dakota, Homestake produced over 40 million ounces of gold. It's never seen modern technology to revamp, and the data room is still analog. It's just getting digitalized today. So do you think that if it produced 40 million ounces of gold, that there's no other ledges there? Of course there are. That's the geology of it. So you look at what's going on in the energy sector. You look what's going on in the mining sector right now. There's massive deposits in the U.S. Rare earths, same thing. Massive development going on, and will continue to do so. It's just, look, people may say, if you want to put it in a macro perspective, God created these elements, the devil took it and spread it around the world. So when it got to like the maybe about late 90s, the gold price and the commodity prices were so low that they needed to reinvest in these existing assets in North America or Australia. And it was easier to go to these emerging markets in Africa, Chile, Peru, and markets that were opening up to get the high grade, near surface return of capital. That's worked its way through. Now you can go back to North America where you've never had. When I remember walking into the data room of Homestake, no one was in there for over 20 years. Well, think about the technology change in 20 years. And this is a prolific gold district. That's happening in all commodities right now.
Well, okay, if it's indeed true that we have abundant deposits in the U.S., why are they not being produced at the same rate as perhaps peers in other countries? China, Chile, you mentioned. Why are they ahead in terms of production?
Well, Chile's ahead. Chile produces about a third of the global, almost 40% of the global copper production because of its endowment for the resources. And a lot of that was actually, those resources were known from 100 years ago. And Chile's gone through 2 different cycles of nationalization from the last 100 years. So if you want some interesting history that we talk about in the book, if you take uranium as a good example, what happened in the uranium sector was when the collapse of the Soviet Union shut down, it was just so much cheaper for the industry to get a depreciating currency. You want to talk about the US dollar versus the other currencies. Part of the reason why the developments of assets in the US was from the 90s. In 1993, the HEU agreement was signed actually in Vancouver. Yeltsin, Clinton, and the Canadian Prime Minister, slips in my mind right now. But anyways, he was a liberal. And I remember the day they signed it, and people didn't realize that you're talking about hundreds of thousands of these nuclear reactors. You downblend it, send the feed, but you're also dealing with a currency. Now, during that same time, you look at what happened to the ruble and the tenge. People have to remember Kazakhstan tenge currency depreciated at a much faster rate than the ruble. Also, their production went from 1 million pounds to over 60 million pounds. Okay, over 40%. One nation produces over 40% of the primary uranium production globally. But they wanted the US dollars because the US dollar was stronger. They didn't really care about their depreciating currency. So if you want an even stronger reason why the US dollar, what are all these nations trading their commodity that they're producing in? They want that stronger US dollar because their costs are in their domestic currency that they're depreciating at a faster rate.
Well, the U.S. government is looking into boosting production of critical metals domestically. Early the year, the Department of Energy.
Permitting is the big one. Yeah, you look at permitting. That's going to take time, but it has happened. So you look at the permitting moving forward. It's always easier to go to an existing mine that produced in the past, what we call a brownfield, and you get amendments to existing permits. That's a much faster route than going to a greenfield area. And in America, people forget how much mining there was. You look at the uranium mines. So now you can go to areas, whether you're in Texas, you can go to Wyoming. There's many areas in the US, if you want nuclear or rare earths, where you can now start that are permitted. And it's taken 10 years to permit a mine, specifically a nuclear mine, because of the NIMBY. So it has been harder this cycle to permit a mine. And I think it's going to continue that. It's not going to get easier, even though the politicians say they're going to make it easier. It's not. So that's part of the reason why, and the investment and the capital to do so. But I think what's happened in the oil patch, you'll see with more development as you see more nationalization, more government take, more of the big majors are starting to look to reinvest in the US, North America. And it's a process. It's going to take many years, just like fracking was not an overnight sensation. When George Mitchell first started fracking, it took 15 years before it became a thing. And then it took about another 6-7 years until it really caught on. So it's a 20-year development.
Earlier in the year, the White House launched or announced the American Battery Materials Initiative. So they have an incentive to actually source critical minerals, secure the supply chain of critical minerals specifically. What are the investment implications of this act getting implemented?
Unless the government is willing to put a bid, meaning they will buy that. That's what the government did. I talked about this in the book when the DOE in 1946 said, hey, we need tungsten and we will give a bid to company. And a lot of people don't know that Placer, which eventually became Placer Dome, which eventually became Barrick, one of the largest producers of gold in the world. Part of the reason why they were able to survive was they had an absolute bid from the government as long as they met the quote, the metrics of the commodity, that the government would always give a bid to it. And that's step one. They're starting to do that with uranium. They got it legislated where they're going to buy from American producers. And think about it. America went from 30 million pounds of uranium produced globally to less than 1 million. I think it was less than 200,000 pounds in 2020, somewhere around there. But you're talking about 98% decrease in production. That doesn't mean the uranium disappeared. It's there. So now you're going to use better technology, better aspects. And if you have a bid from the government, that changes the game. And that's what's going to happen to the critical metals also. And then for lithium, it's going to come from the automakers. The Teslas of the world want a safe, long-term, stable supply of their critical metal. For them, the batteries will be lithium. And having it in Nevada or in the US is the place to be.
Critical metals and perhaps even base metals investors are looking at the data coming out of China recently and wondering to themselves, are my investments in danger because China's reporting deflation in the consumer sector? Demand overall is weak. Growth overall is weaker than expected. Does that mean that copper is going to go down, lithium is going to go down, et cetera, et cetera?
Copper probably, but up to a certain point. You're most likely not bringing in a new copper mine under three. If it's a really good copper mine, 350 is probably a breaking point because of the high capexes of what's called the porphyry deposit, the big open pits. Now, if you're in Chile now with the new rules and the permitting delays, that's where some of the big deposits are being found. And in Argentina, well, I've always said Argentina is where money goes to die. I'm not going to go develop a mine there. Good luck to those who do it, but try to get your money out, specifically when the government fixes the exchange rate again to the US dollar. So there's the Argentinian street rate, and then there's the Argentinian government rate, right? So this damn US dollar keeps popping up in every way. Go look at Turkey. Turkey did the same thing. I talk about all these things in my book. Turkey has some incredible deposits. People don't realize how well endowed Turkey is, both in copper, gold, and in natural gas in the Thrace Basin. But unfortunately, try to get your money out at the real rate versus the government fixed rate, and then you got to pay all the taxes to get out too. So look, there's some incredible copper deposits globally. Look at what Rio Tinto did in Mongolia, and that was an asset that Friedland got from BHP. And how many times did the government move the needle on that company? It's been 20 years of that. If the prize is big enough, it's worth it. But those are very, very rare. So if you're going to play, I would just always factor that you may want to increase your discount to your NAV if you're in one of these emerging market with geopolitical uncertainty.
If you were to look ahead of not just the rise of America, but the rise of global demand for certain critical minerals, and you were to start a mine, you were to, start drilling for a deposit, it could be anywhere in the world for anything. What would you do and where?
I would go to past producing areas that have analog data, meaning millions of feet of drilling of OPM, other people's money, where they have all the shafts and the underground development other people have developed, and no one's actually taken the data and put it together and digitalized it. And then you can use new technology to see, okay, is this a true district? Because if you want something big in mining, if you want to make the score in mining, don't focus on small. You know, time is consistent throughout all, and the majors want something north of 500,000 ounces gold equivalent per year. That's kind of a metric to start at. They want a district, and they don't want to be there for just 6 years. They want to be there for decades. And it's all about district scale. And that's where I would focus on. And there's many areas in the US that I think, and also in Canada. But look, there's other areas in Canada I wouldn't touch with a 10-foot pole because you're not going to get the permits. So be very cognizant that there's the permitting aspect, there's the capex, and how much is it going to cost to bring this, even if it's there. And then grade is king, met is queen. What type of metallurgy is there? So for me, that's what I'm doing with my investments. There's some great projects that I've passed on in areas that are just too politically risky until the score is absolutely massive, like an Oyu Tolgoi or like a pebble-like deposit. You've got to make sure that the reward is worth the risk.
But do you have a specific mineral in mind that you would invest more heavily in?
So a lot of these big deposits, they're never just alone, right? So if you look at like a copper porphyry feeding some of the high grade gold shoots. So generally speaking, it's going to be copper, gold that I'm very excited about. Uranium, lithium's a good place to be. Those are the kind of the base. Do I play around too much into the iron ore? I try to avoid iron ore. That's a tough one.
Yeah. And what's your thesis around nuclear power? We're seeing sort of a bifurcation towards the Western powers and also the East in terms of the attitude. Most of the nuclear power plants are being built in China, India, Russia, some Middle East, where you've got Germany taking down all the nuclear power plants. So are we seeing a rise in nuclear demand or not?
Oh, without a doubt. My first book, The Colder War, I talked about how nuclear it's suffered the China syndrome or the Jane Fonda effect. Nobody wants to talk about it, but even in America, people forget that 1 in every 5 homes is powered by nuclear energy. Unfortunately, with that, 1 in 10 homes in America are powered by former Soviet fuel. So these are the facts that people can't get around from, and nuclear will only be growing. Why is the Middle East even investing in nukes? Because they know it's part of a diversified energy matrix and it's here to stay. And again, yes, Germany shut down some of their nukes, but they're literally importing power from across the river of French nuclear power. So yes, the radiation is going to stop right at the border. So that's just politically driven logic. And that will change with time when the power prices get higher for them.
All right. Well, we'll put a link down in the description to your research. Where can we learn more from your research, Marin?
Yeah, we publish weekly free research at katusaresearch.com. And it's just missives and there's tons of video. And we've been publishing for many, many years. So it's all there. That's probably where you would want to start.
And we'll put a link down in the description to your book as well. Let me just end on this thought. We'll circle back to the book, Marin. When we talk about the rise of America, you've also discussed the rise of China as well. Is it inevitable that China eventually supplants the U.S. as the world's superpower, both militarily, economically, and politically? And I'll get your views on that first and what the U.S. is doing in relation to that view to prevent that from happening, let's say.
I think the American plan is kind of like what they're doing with the Ukraine. So what I mean by that is, will they eventually? Yeah, of course. Eventually every empire will shift, but you got to put it into your own portfolio's metrics. People are investing in some gold explorer thinking that China is going to ruin the US dollar. Well, that's has no correlation to your investment. So what is your investment horizon? And if we're talking on a macro perspective, yeah, sure, they'll both keep moving forward, and the citizens wake up and live, and they're going to do their thing. I think a big catalyst to watch here is how the housing issue in China with the most recent bankruptcy, and how much more easing does Xi have to do and tell his. So as they move the bonds from a municipal to a provincial, at what extent does it go federal? Then you look at, okay, well, we can track how much oil is coming through the ports. You can track how much iron ore is coming through the ports, and then look at the commodity prices. That's where you can't manipulate. And then the big signal will be about Taiwan. And I think that gets pushed out a few more years because the economy is unstable. And maybe a great part of what the agenda is, and I don't think it's Biden, and yes, we all know where that situation is, but we know that there's these bureaucrats in place that understand the power of the US dollar. These are not stupid. These are smart people working, and they're the ones behind the scenes. You're not going to know about them in the social media. And maybe they're doing this tightening for other reasons. And what impacts will that have in China? What impacts will it have in places that we're not even talking about? As the velocity of capital slows down, it becomes tighter on the average person, and do revolutions start happening? So let's see where this all plays out. But I think it's going to be many, many decades. This isn't is it the end of this year or next year? No, it's not.
Well, the investor's probably thinking, what are the implications for me? Should we be investing in defense? Should we be investing in cybersecurity? All of the above? None?
All of the above, because that's where the capital is going to go. And that doesn't mean you're not going to lose money, but you look at in America right now. I'll give you an interesting tidbit. At the big mining conference, and I've been going to this for almost 2 decades, it was the first time where there was a whole floor of auto manufacturers trying to lock down supply of lithium. And these aren't lithium companies in Chile or Argentina. There were lithium companies in the US. And it was GM, it was Tesla, it was Ford. And you get to, when you walk around, you see, these guys because you've been in the industry for a long time, from the company side, and the bankers were all buzzing around there because these bankers are licking their chops on fees. That's what's going on. I think in the technology, they're going to improve the batteries, meaning the cars are going to eventually have less copper as they produce, because that's just what technology does. They'll become more efficient. So, you look at the transition, the grid, power stations. There's incredible opportunity right now in North America. And you just got to know what you know what you don't know, and try to reduce your risks, but look at areas where the capital will flow. And I'm telling you, it's flowing into the US right now, both from external forces of capital going for that yield, and also from the US side of they're going to stabilize, and they've proven that they will backstop the economy if it goes down with stimulus. So that's the game that they're playing with right now. And in my book, I talk about how it's a transition of FMC to MMT, and we're in the middle there. And it's going to be many decades before we get to the MMT, as I talk about in my book. But we're in this transition that they will do whatever it takes. So don't fight the Fed. You're not smarter than the Fed. And even if you are, you don't have more power than them. So just play with the cards you have. And that's what I'm trying to tell everyone to do. That's what I'm doing.
Excellent. All right. Thank you very much. Very thorough analysis and discussion. Appreciate it.
It was my pleasure.
Thank you for watching. Don't forget to subscribe and follow Marin Katusa in the links down below.